This conference will now be
Okay, good
recorded.
day, everyone. I am Steve Szyminski on behalf of Wealth Foundations Northwest. I'd like to welcome you all to the Option Powers webinar. Happy to be here with all of you. Just a quick reminder that your trades are yours, not ours. We don't act as advisors in any way, shape, or form. Trading does, in fact, involve risk. Learning to trade isn't about predicting the market, it's about predicting yourself. And so, what are you going to tell your future self to do based on what some of the possible outcomes are going to be? And this is really key to our topic today. And that is that the market doesn't always do what you want it to do. And so, predicting the market, you certainly try to have a theme, a direction, a forecast, but it's really about trading is really about signposts and about responding to what happens in the market, not always predicting what's going to happen. It's really about managing yourself as you trade. And so the oops, I gotta unhide my slides. Sorry about that. Some of the key slides here are hidden. I mean, I don't know. What I need to do is just jump to the right place. That's all I need to do. Okay, and so what today's topic is when your breakout is a fake out. So there is nothing as wonderful and fun as buying a stock on a breakout, whether you buy a long call or buy a long put when the stock breaks a key level. Okay, it breaks the Donchian channel. There's few things as rewarding as catching a tiger by the tail and enjoying a hard run in your direction. That is so fun. Okay. But fake outs are common after breakouts. So after the breakout, it may not keep running. It may pull back. It may pull back in range, or it may just base for a while. And so, what should you do when your breakout doesn't continue to fly in your favor and it just sort of sags or pulls back or is kind of a fake out? And so we had, consider our case study here on Morgan Stanley. So we had an initial breakout that was kind of a fake out. And then on the second day after the breakout, we had kind of confirmation of a breakout. So, okay. So we went ahead and entered the trade on 6/16 and rode it up a little bit. And so intraday on this day, things were looking fantastic. It was looking like the breakout was going to continue to run. But by the close of the day, and this might have been the Fed day, I'm not sure, but by the close of the day, the market had, or the stock and the market have faded. And so this breakout was felt like kind of a fake out. And so I looked at that, so that's disappointing because now I've established this high point up here and then and so now I'm sitting right here with what looks like an insight day on 6/22. So I decided at that point to sell a short call above the breakout point, so or near this not breakout point but high point. So we sold the 230 call and brought in a nice credit of a couple hundred, $209, as a matter of fact, right? And so here we go. So it kind of it's had a couple of days of down days. Looks like in the pre-market it's going to bounce back again. That's great. But the point here is we've actually, as of yesterday, have actually lost money on the long that we bought here. So the stock is just slightly lower than where we bought it. Okay, when we bought that call in 6/16, the stock is slightly lower than it was when we bought the call initially. So we've actually lost about $70 on that long call, but we made the lion's share of that $209 on the short that we sold here. And so our net is we're up $114 instead of being down because of the short that we sold. Okay. And that short is going to expire worthless today. Today is 6/25. That short is going to expire worthless today in all likelihood, right? Unless it runs above 230, which is not likely. So I'm in a position where, okay, well, I can keep this cash flow going, which I think I'd like to do because you still have that same overhead kind of, resistive area up there, it looks like. And I'm just going to continue to sell against this in what appears to be maybe sort of a basing pattern here above the initial breakout level. Okay, so that's what this appears to be. So I'm going to continue to sell shorts. And so sometime later today, you're going to see an alert that shows me closing the old short that expires today or tomorrow, that expires tomorrow. Today's the 20th, Thursday, the 25th. So this expires 6/26. It's near worthless, but not quite. Still has a little bit of value left in it. And we'll look to roll that either today or tomorrow and let the theta decay continue over the weekend. So I'll close the one that expires tomorrow near worthless for a profit and then sell another one out to next week. And so, but I'll remain flexible, just in case it looks like this thing may surge, or whatever. We'll have to watch it throughout today, and maybe even on Friday. But I'm inclined to close that profitable short and sell the next one and keep that time decay in our favor because we're long all the way out to August. Okay, but the important thing is this trend is still intact. Okay, the trade isn't broken. It still has 20 and 50 SMA support. It still hasn't even gone below the initial breakout level. The on-balance volume still looks okay. Everything looks fine as far as the trend being intact and everything, even though it dropped, $6, kind of spooky. But I think that the trade still is manageable, and I think that's how we're going to trade it. We're going to trade it now as a horizontal spread until further notice, right? If it breaks 230 again, which it easily could do, then I may take a breather from selling shorts, and I may let the breakout run again, and then start the process all over again. So let me give you my final thoughts. And then a breakout is a fake out. Notice the nature of the fake out. Okay, what do we want to notice about that? Well, did it lose the initial breakout level? In the case of Morgan Stanley, it did not. And so does it look like it wants to base here for a while? Are the candles back and forth, or are the candles big or small? Just kind of what is the nature of what you're seeing here? Ideally, when you sell the next short, if you sell another short, then if you can get it on kind of when it has kind of a bump up, that's ideal. And that's kind of what I did on Morgan Stanley here, is you had a bad day, and then the next day it kind of had a little bit of a bump up, and selling that short into that little bump up turned out to be a nice move. Okay. And so kind of read the room is what I'm trying to say. Read the room with that stock. What does it want to do right here? And, most breakouts, when they break out and then they fake out, they usually recover. Okay, so if it breaks out and then fakes out and doesn't really keep running, usually it'll recover, and then it's only a matter of time. Now it could be a long time, but usually it's only a matter of time before it breaks out again, typically, right? But use a stop in case that's totally wrong. At some point you got to say this trade is broken. It's lost its trend, broke a key level, went back below the breakout level, and doesn't look like it's going to recover, or it's got such bad downward momentum with big candles working against you to the point where you can't even imagine this thing ever recovering. Then certainly have your key levels identified where you simply will just pull the plug on the trade. Sell shorts beyond the recent high or low. So we sold it out of the money at 230, right near that Donchian channel. So identify that recent high or low. So when you do decide to sell short, make sure the stock has room to run up to the recent high or low. So be strategic where you sell your shorts is what I'm trying to say. Don't do it randomly. Do it based on something. And be prepared to close or roll if your short gets threatened, or if regardless of what the trade does, be prepared to be flexible with how, where, when if you're going to sell the next short. That is the nature of horizontal spreads. And so that's what I mean by read the room. If it breaks out again, raise your stop. Find a recent, pivot point or something, or find the moving averages or find something you can use to potentially raise your stop each time that happens. Now, my mentor, the late great Courtney D. Smith, he used to love to pyramid. When a breakout broke out again, anytime a breakout breaks out a second time or additional time, he used to like to add to the trade. So he always thought that amateurs added to losing trades, but pros added to winning trades. So when the pro gets a hold of a winning trade, they're like, maybe I should put more money into it. This trade's going so well, maybe I should put more money. And that's exactly the opposite of the typical amateur mentality. So if an amateur gets a little bit of a move in their favor, they can't wait to take profit. But if it goes against them, they can't wait to double down. And so we don't want to trade like that. Now, I'm not as aggressive with what we call pyramiding, which means to add to a winning trade. I'm not as aggressive as Courtney was doing that because, when I allocate a certain amount of money toward a trade, I usually don't like to violate that or start throwing more money at trades after the fact. But occasionally I will. And so that was his favorite time to add to a trade. That's all I got on behalf of Wealth Foundations Northwest. Been my pleasure to have been your coach today. Good luck at trading, everyone. Take care. Bye bye.